Ladies and gentlemen, it's come that time once again where we will have our monthly strategy meeting. This is where we bring our trading team in and discuss some of the key themes that we may be seeing. And this may be a big one because we have earnings season right around the corner. In fact, it starts next week with the banks. So we're going to bring in our trading team. And as usual, we're going to start with a top-down approach, and that means chart trader Brett Manning is going to kick things off. And good morning, Brett. How are you?
Doing pretty good, Jim. How are you?
Doing quite well. So I want to kick things off with you, and let's talk about what you think regarding the potential for inflation, particularly around the commodity and asset prices.
Yeah, so I mean, right now we have one context that's very clear, and I'm sure we'll all talk about this. It's sort of a split market that maybe shows technology on one side and banks on the other would be a simple way to look at it. You can also look at NASDAQ versus Dow. There's also a comment in a recent Bank of America piece of research that stated basically that if the S&P was just technology stocks, healthcare stocks, and Amazon and Google, the S&P right now would be at almost 4,200, and everything else would be at about 2,900. So you can see there's this really obvious split in the market, and the type of split that it is besides being a narrowing of breadth, it's the hallmarks of a kind of deflationary or disinflationary kind of market. Because you've got a flat yield curve, and the suggestion the yield curve will stay flat. You've got a premium on the types of things that don't cost a lot of money but can have high productivity, and you get the premium in the healthcare sector, biotech or in the technology sector. But biotech and healthcare is a little different because we know that really has to do with the virus. But you have this kind of people preparing for a long-term disinflationary or deflationary kind of market. And that makes sense given the force that's in play and the hit to consumer activity, and trying to pull through by using different forms of stimulus to keep things afloat while there's this kind of lid on the amount of consumer activity that we have. That makes sense. But I feel like there's the possibility sort of around the next corner for a shift into a different kind of context, because the same thing that's causing that deflationary pressure and the risk of deflation is also likely causing problems in terms of inventories, in terms of production of commodities, because the producers in that situation have to worry about another big hit to consumption that dwarfs what we've been seeing for the last couple of months and is more similar to what we saw back in March and April and early May. And so preparing for that, because they were stung so badly by that process. And yesterday when Gavin and I talked, I used the simple example, sort of a microcosm of that in the oil sector, that it's easy to see how there's a risk that oil producers could be getting behind the curve right now in terms of bringing production capacity back online, because that entails a fixed cost investment. And if they're worried about another big hit to demand, they may be reluctant to make that fixed cost investment and bring more capacity online. So there's the risk that they would continuously be coming further and further behind the curve if demand picks up and if we don't actually see things shut back down. So while you've got this heightened virus data, particularly in the southern states right now, where it looks like we're setting new records. The United States is right now unquestionably setting new records in terms of number of cases per day. So it gives you this sense that it could be, at any time this could blossom into a new sort of lockdown, shutdown situation, and we get this new big hit to demand, and you can just see how producers would be constantly braced for that. And that state being braced for that, if we don't end up seeing that shutdown, if we're starting to normalize behavior within the context of this risk, then there's this, I think, real risk that you end up with, especially given all the liquidity, you end up with a situation where you just have too much money chasing too few goods, and it really reverses the context that we're in now. So I have my eye open for those types of changes and the possibility we could see some spikes higher in commodity prices. Copper's really running. If we see oil move back above the 41 to 41.50 level, we could see a real kind of squeeze above there, especially if you don't see if you start to see some big draws, we saw big draws in the products. If that translates into big draws on the crude side in coming weeks, and we don't see rig count swell, wells reopen, production capacity brought back online, you get that kind of dynamic that can, I think, feed on itself. And again, that's sort of a microcosm, and I think it could apply more generally, sort of across the economy, and it really would be a flip in context.
Brett, I'm curious, how do you know that the oil companies may be reluctant to bring supply back online? As you kind of stated, it seems like they might be suffering a little bit from PTSD, but what's to say it's not a strategic move in order to boost oil prices?
Well, they wouldn't benefit from it. I mean, that's one of the reasons you're seeing such a divergence between something like, let's say, USO and XLE, is because oil producers don't make a lot more money when they're not increasing production as price goes up. So if this really is a reluctance to bring back, I mean, they're at abnormally low levels of production right now. So if there's a reluctance to bring back to a typical level, then you see the price of oil going up, but them not making much more money, because while they're making more margin on each unit of production, they're not making as much as they would if they had more normalized production overall. So if it's going up because they won't bring capacity back online, they wouldn't benefit from it as much as they would when oil rises under normal circumstances.
All right. Now,
That makes sense?
yes, it does. Thank you. And I do want to ask you one more thing. You had highlighted the potential of another lockdown in the economy. So I'm curious if maybe this lockdown may be in limbo. And the reason why I bring that up is we know this administration stance that we're not going to suffer another lockdown. We're not going to put the economy on hold. Now, come November, that may change. If we did have a change in administration, does that throw the whole lockdown question? Things by that time we will have known whether we get the second wave of the coronavirus, and we could have a completely different stance from a new administration. Is there some potential there?
I think that if it looks like we're not very close to a vaccine for some reason, and it looks like maybe it's become, let's say, more severe in some way, then I think that would be true. Otherwise, it looks like we're gradually improving our ability to treat it, and we're gradually getting closer and closer to a vaccine that could by mid-November feel like it's sort of just around the corner, and maybe we even already have it in the hands of some of the first-line responders, at least an initial stage of vaccine. So I think that that's a lot of unknowns there.
Right, and that's one of the reasons why I wanted to just bring that up. So really, the potential for the vaccine is probably going to be the real driver here. Is that kind of the assumption that we should make going forward?
Say that again. Sorry.
Just the fact that we really are, the economy's somewhat resting on a vaccine, because it looks as though we're entering a second wave. Now, whether we lock down or not is one question, but to get us out, that vaccine is going to be the key. And as we get closer to the end of the year, which we're going to have clarity over what the next 4 years are going to look like as far as administration, and that's been the kind of roundabout target that we have heard about potential for a vaccine. So that's going to be the real key driver, no?
I think unquestionably.
All right, so we're going to have to really focus on these headlines of the companies that are coming out with their updated results, like Gilead. Again, we wanted to highlight, I know a couple of the feedback came back and said that the Gilead drug is more of a remedy and it's not a vaccine. So thank you for clearing that up for us. One of them was a ER doctor who chimes in quite often, so appreciate that. All right, so with all this said, Brett, this gives you a bearish stance on the dollar, correct?
Yeah. I mean, I've been bearish on the dollar for a while. I mean, the last 2 or 3 months, and I continue to hold that stance and continue to sit long gold. But I think part of that is also we have morphed into a situation where we have relied more and more heavily on fiscal stimulus. And in election year politics in the United States, I think putting the stimulus lever in the hands of politicians who are running for re-election actively is unquestionably a bearish overall context for the dollar.
All right. And I think the question is not just it's more of a question of how much the stimulus is going to be heading into this election, right?
Yeah, unquestionably.
All right. So I know you are long gold via GLD. Scott is as well. I think Gavin has some things that he likes about gold itself. Where do you see targets in this?
So we are seeing massive inflows into gold right now. I think we're setting kind of cumulative records, but we don't have a tremendous sense of a large speculator interest in, let's say, CFTC data. And, I mean, I've traded gold for 20 years, and I just have gotten to the point where this is a major market that there's a lot of speculative excitement about. And I feel like that's where this trend ultimately wants to progress to. Maybe consolidation in between, but we really aren't very far from starting to get the drumbeat around testing all-time highs, which, maybe we're $150 from, and the trend is steadily higher. And again, if we don't see that we've surfaced into this state of kind of euphoric evolution of a bull market trend, and maybe that's where we're headed, then I think that you could have some pretty dramatic upside targets if we start to see blossom into that kind of market, especially if the dollar continues lower. So I would think at least a test of all-time highs.
Funny enough, I remember when gold was going crazy back in the early part of the of 2000, and you had gold bugs out all over the place. I don't see them as much anymore.
No, right. And I mean, I'm imagining that's a possibility as this
I,
intensifies.
I think so. I think that's still. We talk about money on the sidelines. The gold bugs are still on the sidelines. Just wait until they get back involved, I think. That might even boost things quite a bit higher. All right, Brett. So one of the bigger events that we're going to have to talk about is earnings season. And so I'm going to invite a couple of guys who follow earnings pretty closely. That's Event Trader, Gavin McGuire, and Craig Respasarda. And he is known as Trend Tracker. So, guys, we're heading into earnings season, banks kicking things off. I think so far so good as far as some of the early readings that we've gotten through. So what's your overall, what are you looking for coming out in, or actually coming into this earnings season? Go ahead.
Do you want me or Craig to start first, Jim?
Why don't you?
Okay. Yeah, I mean, like you said, so far so good on the earnings season front in terms of pre-announcements. Craig had noted a couple of weeks ago, and it was pretty good call by him, that we'd probably see an uptick in pre-announcements for the very simple reason that there isn't a lot of guidance out there, and therefore people don't want to take people completely by surprise. But some of the late June and May end reports that we were seeing, such as FedEx, Micron, they were all coming in pretty good, and that's setting a positive tone going into this earnings season. So should be pretty interesting to see if we could see follow through, because obviously we'll be seeing a lot more with the month of June involved. And there was that second wave of shutdowns that were slowly starting to creep in at the end of June. So one of the key themes that we're going to be watching throughout this entire earnings season is linearity comments, and it's a term that we've been beaten to death, but really since that March lows, it's what the market's looking for. How quickly is this recovery going to go? The stock market's done a bit of a V-shaped recovery at this point. The question is, will the earnings and the economic data follow suit? And that's what we're hoping to find out in the next couple of weeks. And naturally, one of the big proponents of this is going to be the banking sector, because we just, it's the lifeline of the global economy in terms of lending, the customer strength or the consumer strength on the mortgage and credit card side. So all these things are going to be key factors going into this earnings season. So next week, we got Citigroup out on Tuesday, JP Morgan as well, and Wells Fargo. That's all Tuesday before the markets open. Goldman is out Wednesday before the markets open, and then Bank of America and Morgan Stanley. They're the big money centers. We got a lot of regionals, such as PNC, USB, that are going to be sprinkled in there. So what we're going to be looking for to kick off earnings season is what they are saying about, number one, we'll be taking a look at their loan growth just to see what kind of demand is there. Obviously, expectations are going to be down a little bit more, but it is going to be an important read into the strength of the economy moving forward. Obviously, companies take loans and then they go and put that money to work, either through buying orders, through R&D, whatever it might be. So that's going to be giving us key insight into the economy. Second part that we're going to want to be keeping a close eye on is credit costs. We saw a lot of banks start reserving for the expectations of a downfall. We've certainly heard a lot about the foreclosures going on, the programs that banks are running in order to offset these with forbearances. We also will be keeping a close eye on credit cards. The credit cards do come out in the monthly metrics, and so far they've been generally positive. So that could bode well for the banks. But what you're looking for here is what they're going to be doing with their reserve ratios. And that'll kind of give you an insight into what they're seeing in terms of the financial health of both corporates and the consumer as they look to protect against delinquencies moving forward. So the delinquency data probably will be relatively flat going from Q1 to Q2. But if we see banks continue to increase the reserves, it's going to raise a little bit of a red flag. Now, I posted a comment back on July 7th that outlined some of the commentary around the banks and what they were saying at the Morgan Stanley conference back in early June. And Morgan Stanley, I thought, laid it out pretty well in terms of they had a statement. They said that the first two quarters they said, I think the first quarter or two are worse than you'd expect, but the probability of the following 7 quarters or so could actually be much better than we might expect. So they said that this might be an optimistic outlook, but that's what they were seeing. And we're going to want to see a repeat of that. But one of the key things that they were also noting was that there was a huge range of possibilities going out, and they were likely to reserve for the worst case scenario. So you do have to keep that in mind and measure out what they're doing with the reserve builds and what they're saying about the outlook of the economy. This is going to be for across that banking sector. Within that comment that I posted, you could see what the reserve builds were for Q1. But this is really going to set the tone for the rest of earnings season and something that we're going to want to keep an eye out for. And I'll be talking about this a lot next week. The other key thing for me for this earnings season is going to be the semiconductor and cloud software space. With this in mind, we saw a really strong quarter from Micron. We saw Taiwan Semi come out with good guidance here. So one would think that the semis should be rallying aggressively on this, but we're not necessarily seeing that follow through. And we know that the valuations for these tech names are extremely high. So do we kind of hit that point where there's really no good news left to drive this higher? And perhaps that leads to a little bit of profit taking in the space. And if that does happen, do we see money floating into other areas, the beaten down airlines, for instance, or retail? And I think that's going to be one of the key things that I'll be looking for at earnings. Craig, I don't know what some of the points are that you'll be looking at, but I know you usually have a nice lockdown analysis on this tech sector. So you got any thoughts on what I just said with that?
Yeah, so I think it's all pretty spot on. Obviously, I won't touch on the banks too much, but software in general should, it's kind of a safe space. And as you sort of mentioned, chips are strong. I think it's it's helpful to kind of think about semiconductors as almost the transports of the new digital economy. As everything is going digital, it's benefiting software, and it's benefiting the semiconductors that kind of power that digital economy. So that's why the tech sector is just on fire in general. More broadly, I think it's going to be, as always, it's important to remember this whole Wall Street game. Estimates have come down a lot. So the Q2 estimates in general are very low. Nobody guided for Q2. So analysts had to be conservative and cut estimates. So when companies come out and beat, most of the results will still probably look pretty bad. They'll look awful year over year, but they'll be beats. So I think it's going to be important to focus on, as you said, what happened in June or even in July. I mean, it had to have gotten better for pretty much everyone from April, right? Everything was shut down in April. May, pent-up demand has spilled over. Everything looked really good, but what has happened in the latter parts of June or even July, I'm assuming outlooks in terms of Q3 or the year will be pretty scant again. They're going to be pretty tight-lipped because of the uncertain outlook. It's the excuse that they can kind of lean on, which is understandable. But we're going to see plenty of games being played. A lot of metrics. You'll see companies that will say we're off whatever percent or up whatever percent off of April or the bottom or May, which is great, but I guess focusing more on year over year kind of stuff can put things in better perspective. I would hope that everyone has rebounded nicely from April or May. I think it's kind of going to be more of the same, where it's going to be cautious, very little visibility, and uncertainty. So I think it's just always going to be pretty important to focus on the most recent metric or data point for whatever, depending on the industry, whatever it is. A lot of times it's just, kind of sales or demand. But so I think it's kind of going to be more of the same in terms of latching onto the most recent data and
So, Craig, I think part of the reason for what I'm seeing so far in a lot of these big earnings beats, I'm curious, where do you think the analysts are getting their numbers for their models now? Is it somewhat arbitrary? Are they kind of guessing, and is that why we're leading to such big beats in revenue and EPS numbers? Like today, Greenbrier came out and they just blew away estimates. And Gavin and I were kind of wondering, well, what was leading that upside? Could it be that analysts are just dropping their numbers just too low and not really modeling it even modestly correctly?
Yeah, I mean, we got to think back to 3 months ago, what was going on, right? In May or April, literally everything was on lockdown, and the companies were, management was essentially scared to death. We have no visibility. We don't know what's going to happen. So, the analysts had to kind of assume the worst. Of course, things have gotten sequentially better since April, May, June. Things have improved, but to which degree? If we can go back to April and remember, we had no idea what was going to happen. So it's just, it's all about expectations. So if you look at Greenbrier, I haven't looked. Their revenue is still down significantly. They did blow out earnings. There might be some items in there, but it's all relative. The estimates, the analysts had no choice but to slash estimates significantly. I think I saw something, they were down something like 40% for the second quarter, the biggest reduction since 2008, right? So it was, everything came to a standstill. And I think we're probably going to see a lot of these beats, just because 3 months ago was essentially the bottom and everything's gotten better since then. So it's a very low bar that companies are going to be facing in general.
Yeah, I mean, on average, they usually have about 70% of companies beat. Craig, isn't that about where the number is?
Yeah. Yeah.
In a normal time frame. So yeah, I would expect that number to be
Exactly.
higher this time around.
Exactly. That game is always in effect. They always, the general Wall Street game is you set expectations appropriately low so that when the reporting time comes, you beat, and then you set expectations appropriately low for the next quarter so that you can come in and beat again. So now it's just kind of to the extreme in terms of everything was at a standstill. Estimates just fell off the cliff, and meanwhile, the economy has really bounced back strongly since then with a lot of pent-up demand. Charts. Brett has noted that the economic surprise index just hit an all-time high recently because there has been this pent-up demand. We can't deny that the recent jobs data has surpassed expectations, but what's the big question is, are the recent lockdowns and is it flatlining now? Is it going to revert back, or is it all kind of just going to be a blip on the radar and everything can keep chugging along, despite the outbreak that we have in certain states? So
Yeah, and just to build on that too, S&P, the Cap IQ, they put out a report. All 11 S&P sectors are expected to be down. So this is pretty much across the board. Utilities expected to hold up the best year over year. Obviously, everybody still needs their gas and electricity. Then IT would be the next quote unquote strongest, as that's only expected to be down about 9%. And then just going down in order, you got consumer staples, healthcare, communication services, materials. The overall S&P is expected to be down about 45%. This is according to analyst estimates. Financials down about 48%. Real estate down about 61%. Obviously a big hit to the commercial real estate there. Industrial is expected to be down 88%. And then consumer discretionary and energy are expected to be the two hardest hit areas on a year-over-year decline, with obviously those low oil prices being a factor for the energy space.
Can I just insert something real quick in this discussion? So,
Sure.
So the City Economic Surprise Index point, it shows that the data's been really good, but I think the other thing that it shows is there's a clear and pervasive cognitive bias for people to underestimate what's happening. I think that the City Economic Surprise Index, it shows the good data, but also the low estimates. And I think that cognitive bias is probably going to be a factor in earnings season as well. It just, you look at the world feels awful. And so there's just going to be this almost subconscious downward pressure on what you think can be happening. And I think that's another major reason why we've seen such a massive spike in the economic surprise index on the upside.
right, so that works from the top down, like what you're saying, and also in the bottoms up estimates for all these companies.
I would think so.
So yeah, I mean, taking a step back, I would think generally, yes, of course, everybody's going to be beating because estimates are so low. And of course, the numbers are still going to look pretty bad for most companies year over year. But so then it comes down, and most people aren't going to give guidance. They're still going to remain somewhat cautious. So it comes down to like, what have you done for me lately? What is the most recent trend? What is the outlook really? And a lot of companies will be hesitant to divulge too much information. So, as always, it's kind of just getting a better read on what's happening, because a lot of these numbers beats, relative to expectations is what we kind of look at, but it's all kind of gamed and obvious, I guess, in retrospect after the fact. So it comes down to the current outlook, and so we'll see how that all plays out. Yeah, I mean, it's easy to remain bearish because the economy and year-over-year numbers will still look bad, but continued sequential improvement will probably be enough to maintain momentum. But who knows?
It sounds like that one of the more prudent things to do this earnings season is pay attention to what they're saying in conference calls, because if they're not going to issue any type of guidance, then perhaps any sign of visibility may be what the market might be looking for as far as the trajectory of what we should be seeing. Just any glimpse.
Yeah,
Yeah.
yeah. I mean, obviously, whatever they're saying went on at the end of June and into July is going to be closely followed, especially since we're getting another dust up of the coronavirus and we're seeing places like Texas locking back down. I know Google Maps data from there recently just showed that that was on a decline, which suggests there's less mobility there. That's been a key read for people for trying to get a gauge of how the economy is performing. So those linearity comments are going to be key. Have we kind of hit that inflection point on the recovery where now we're just going to kind of go sideways? And if that does happen, does that lead people to maybe bank some profits in a highly valued market, or are we continuing to see more upside on the recovery? And that's certainly going to be a key aspect.
All right, let's shift gears a little bit and talk about sector rotation. I think it's going to be a key theme here, and Blue Chip, you've highlighted it quite a bit. I mean, just looking at today, we're seeing movement out of tech and into some cyclicals like energy and financials and whatnot, but this kind of changes on a daily basis. What's your thoughts?
Yeah, it feels like a daily basis. Lately, it seems like it's been a little bit longer time frames. But the sector rotation theme has definitely become a more prevalent part of this market since the recovery efforts. Back in March, it was baby in the bathwater. Everything, just went down no matter what it was, unless it was Clorox wipes. But then everything recovered and had that dead cat bounce sort of feel going into April as well. But then somewhere around the May timeframe, really started to separate the wheat from the chaff, and it was really kind of this emerging relative strength and relative weakness that was coming about there, and it was pretty obvious too. I mean, it's almost like a tale of two tapes going on here. It's basically the new economy, if you want to call it that, based upon people having to work at home, school their kids at home, as well as eat at home, and everything that revolves around that, which is mostly technology and a little bit of healthcare related groups in there, which just propelled the NASDAQ higher. And then everything else, the old school economy, your industrials, your energy, your financials, just really just kind of lagging and underperforming. And then, of course, everything that's associated with the CARES Act, from your recreation, from cruises, vacations, hotels, casinos, airlines, restaurants, storefronts, anything else like that. So it's really just been this huge split in the economy. And I think we're all on the same page regarding that. But I know this is a strategy meeting, and I think you guys did a great job at covering that big picture and things and events we have to see from a big picture down the road. But from a little bit more of a tactical, shorter-term trading perspective, I mean, the opportunities are really just about zoning in on relative strength and relative weakness. And if you're bullish, you got to be involved on what's working and what's strong, and clearly that's going to be all of the technology related names, and it just goes across the board. I mean, from software to semis to internet, social media, cybersecurity, cloud computing. If you need a list of names, the liquid momentum focus list just basically zones in on like the strongest names that are just leading the market higher. It's just 95% of those are basically technology driven at this over the last few months and whatnot. Then followed by some healthcare related groups as well. If you're bearish on this market, I still think that energy and financials remain some of the most underweighted areas by portfolio managers in this market. They've been underperforming for months, if not years, and every one of those rallies just presents fantastic opportunities to sell into. So you might get a little bit of bounce right now because we do have earnings season coming up next week, just kicking off with a bunch of financials. I actually took a long in the FAS here earlier this morning, looking for a little bit of a pre-earnings drift higher or pop higher going into next week amongst like JP Morgan, Goldman Sachs, Citibank, etc. So I think you have a nice potential short-term trade to happen there, putting stops in around recent lows. Um, but overall, I just say you just got to continue to focus on those bigger trends, and then just look to fade the pullbacks in context of those trends, because that definitely seems to be the norm that's in play. Some other emerging areas that we have just started to see some really good relative strength, like you said, Jim. There was a lot of us are long gold. I think Gavin's been holding it the longest for like the last 3 months. I know Chart and I have been jumping in and out of it for various trades, but we're all pretty much holding a piece of it as it moves to recent highs this week. The bond market, that's starting to perk up a little bit. Bonds themselves, like on an aggregate total basis, they have been on the rise into the latter half of June, but as the U.S. Treasuries, the TLTs, the IEF, all these Treasury-related ETFs are just starting to move a little bit higher here. And it's just an interesting dynamic, because the last time we saw gold and bonds also rallying with the NASDAQ, it was all back in January and February of this year. During that time, we were starting to see divergences in the Dow and small caps and mid caps going into February, not keeping up with the pace. So overall, is this theme of this new economy throwing in money into the strong technology arenas, but everyone is really nervous, and there's still a lot of unknowns and questions. So they're also putting money to safety as well in gold and bonds. And of course, like Brett said, the U.S. dollar is underperforming. You have inflationary concerns coming down the road. It's all just fitting into this whole big narrative almost perfectly. And as long as you continue to focus and not bet against these big themes and trends that are in place, I think there's just a ton of money to be made. And the best part about it is the volatility. And if you track the VIX, which we discuss almost every single day here, it's trading around 28 right now, but it's been around this $30 area, which seems to be like a sweet spot for the market. It's really just presenting a ton of trading opportunities for day traders or for swing traders, and it's really just kind of this fantastic vibe. And I think that's one of the reasons why you've seen or you've heard about this rise of the retail trader over the last couple months. Now granted, unemployment is high and casinos are closed, so you have this this culture of people who are looking to do something with their money, and if they're not starting businesses or putting their work online somewhere, which explains why Shopify, Square, and Wix have all been just skyrocketing lately. They're probably trading in the market, and we have seen that through the data points from Robinhood, which is the I guess an online trading brokerage, that it has increased dramatically here. And that probably also explains too, on a separate note, we've seen the put-call ratio at pretty depressed levels below the 1.0 level and maintain those levels for quite some time. And it's probably just explaining that a lot of these traders are favoring buying options on a lot of these rising technology names. So it kind of all fits into that same narrative. I know also from the TA page scans, all the way at the bottom of the page, I have a scan that tracks very strong uptrends in stocks trading underneath $20. And I nicknamed them the zippers, because they usually tend to just zip higher. And over the last 10 years or so, I'd say that normally I get somewhere between, say, 5 to 15 names appearing on the list. I'm up to about 40 over the course of the last 2 months or so, which just, again, confirms that there's this desire or this need or this market for very low price stocks, very small accounts, so to speak, to just jump into these names and just continue to propel them higher. And I'm not gonna, I mean, the list just goes on and on, from everything from DraftKings to Workhorse to NKLA. Just so many different names have just, quadrupled in price over the last few weeks there. You put all that together, and it's just very, very reminiscent for me of the late 90s tech bubble. Now, the tech bubble did last quite some time. The VIX was high during that time. It was trading around the same areas. The technology bubble was, something that a lot of people participated in. And then there was even a time where, I remember the taxi cab driver, trading from their while they're doing rides, in between rides. You had my mailman was talking to me about trading stocks. My brother-in-law at the time, who was I think he worked in a bowling alley, and he was trading stocks. I mean, so it was just kind of this whole retail dynamic going in play there, and everybody was making money and learning about the market and everything else. Unfortunately, it ended really bad. So again, I'm not saying it's gonna end bad. I'm not saying when it's gonna end bad or it's gonna happen anytime soon. But if the bigger picture narrative, I think we just continue to ride those trends higher for as long as we possibly can. But I wouldn't say you throw caution to the wind, because when this music stops, it is going to get pretty nasty down the road. So just be well aware of that.
I'm just curious where the music stops, because we have a whole lot of liquidity provided by the Fed. So that's one of the conditions that we didn't have back during the tech bubble. But I do think it's noteworthy that you highlighted the fact that bonds and gold have been on the rise again, and that was a precursor to the correction that we saw in March. Another thing that you highlighted was the put-call ratio. Again, we're starting to talk about, wow, I haven't seen this above 1 in weeks. And that was one of the things that we kept talking about in February, if you recall. We used to talk about it every day, another day. It's not even over 1, let alone anything that would suggest that there might be, some big time hedging going on with a number like 1.35 or something higher than that. So we do have those conditions, but we also have the Fed with a lot of ammo left. So that's the conundrum, I think.
I know the Fed is supposed to be separate from the president, but what if there's a new election regime coming in come November? I mean, that could potentially influence the Fed, right? I don't know if Gavin or Brett want to chime in on that.
Sorry, Scott, you caught me eating a grape here.
So basically, if there's a new regime in control of the White House, I mean,
new regime. So basically, what you want to keep an eye on is now. There's no saying that Powell would be removed. That usually the Fed chiefs have done multiple terms here. It's a 4-year term, so I think it would be about a year in to Biden's term when there would be a new Fed. But there has been talk that if Biden got in, that he would perhaps look to replace Powell with Lael Brainerd. If it was Trump, we've seen plenty of his tweets about the Fed. I'm assuming that he would look to get in some sort of Uber Dove to help with his policies. So I don't think we'd see any sort of reversal in the policy action like what we saw when Obama and Trump had the transition with Yellen, when all of a sudden they did a pivot there. Now there was a lot of good reasons there, as the economy was performing much better, and we were slowly trying to wean ourselves off of the stimulus packages that had basically been around since the great financial crisis, at least the low rates anyway. But for now, I wouldn't expect a marked change in Fed policy, just no matter who gets into the presidency.
One thing I would add is a change from the current administration would mean an increase in the independence of the Fed. So it becomes less of an issue. Politics becomes less of an issue, I think, with the Fed if we shift administrations. This has been the administration that we've been seeing for the last 4 years has been much more active in attempting to sway Fed policy than I think that we've certainly ever seen in my lifetime.
At least publicly, for sure.
Sure.
Yeah, and I know everyone can get all a little hell-bent on who's in president and whatnot, who's in power, and what parties and stuff. But if you go back in history, honestly, the stock market doesn't care. I mean, it really doesn't care. Now, of course, certain administrations have their own agendas and their own regulations and their own policies that they're looking to implement. So there are certain sectors and industries that are definitely going to be more affected by who's in control. However, the market, the money flows from one side of the economy to the other side. That's what causes cycles in the business world. And it's just a matter of recognizing those cycles. So, if you just kind of pay attention to that, that's why it always kind of bothers me when these you see somebody who's a permanent bear all the time or a permanent bull. Well, it just they miss out on the where to be in the cycles, and this is why I always focus so much on sector relative strength and relative weakness, because it's really what's in favor right now as opposed to one other group. And if you look at the weightings and the way these the major indices are structured, they're market cap weighted, they're price weighted. So the stocks that do better during certain cycles of the economy are going to be represented by the market itself and therefore do better. And the ones that are being hurt by the administration or economic policies that are in play are just not going to be part of the market. And it's that simple. They fall off the calculation there. And I think people sometimes put a little bit too much emphasis on who's in power. Now granted, I would there's so many different arguments. I'm not going to start a political debate or anything like that. But I think it's just something to step back and think about, as opposed to being a permanent bull or bear just based upon whoever gets elected down the road.
Yeah, I'd agree. And past studies show that. I mean, there's really no significant difference between a Republican in office or Democrat in office with how the markets performed. I would say one thing, though, if you see comments from Biden, such as that he wants to end the era of shareholder capitalism. And that's what he said yesterday. I'm just saying, that can cause a little bit of a shake up of the market and lead to some profit taking for sure for capital gains tax purposes and stuff. Yeah. So I wouldn't discount it on the short term, but like you said, for a longer term prospect, I wouldn't put too much emphasis on it.
I think if you look at things from a capitalism versus a socialism perspective, then things can get a little hairier. Because the one thing that's driven the market over the last 100+ years has been capitalism. It's plain and simple. It rewards. It's Darwinism, whatever. It rewards the sectors that do best and the people that work the hardest. You start spreading the wealth around, I think that could potentially, hurt the system, hurt the whole system as a whole. Anyway, but real short before we jump in, I know Damon wants to talk about some sectors that are an area that he's interested in. Just some groups that have been really kind of perking up, as well as bonds and gold. Chinese internet names that have been on fire here the last week or so. Look for them on pullbacks as potential buying opportunities. Solar stocks also, the TAN ETF, and I know they're China related. They've actually been really strong as well. I would also be taking a look at them. And then, Jim, if you want to go into what I think Damon has an area that's been pretty hot lately.
Yeah, and so Damon, you've been pretty quiet not only on this call, but your trading calls as well. But one area you've been really focused on is the SPAC area, the special acquisitions area. So why don't you just give everyone just a quick little snapshot of what this is and why you like it?
Okay, so I talked about this last call a month ago, and it's really before there's a lot of publicity associated with them, and over the past 2 or 3 weeks, they've gone nuts. I wrote a comment on Monday pointing out that I saw, I think, 17 or 18 on the 52-week high list just on Monday, which is pretty insane. But they've become kind of the new IPO, and so basically it's called a blank check company, referred to as a blank check company. Company does an IPO, maybe raises $200-300 million and goes out to find an acquisition. So it's basically publicly traded private equity. And so of late, these companies, these creators of these blank check companies have been doing a really good job finding the types of deals that will get investors excited. And so we've seen a number of electric vehicle deals over the past few weeks. We have a swing trade on right now. Actually took some profits this morning in SPAQ, which is Spartan Energy, which is reported to be the lead bidder in a bidding war for Fisker, which is the creator of the electric car in the United States. They actually came to market maybe a year or two before Tesla did, and it had a beautiful car. I mean, actually, I saw one a couple of months ago that was still moving around. That was still on the road. An absolutely gorgeous car. And I think they had one of their major issues is, well, they weren't publicly traded, so they couldn't go to the stock market to raise capital. They had an issue with their battery suppliers. I think their batteries were kind of duds, and Tesla just kind of blew them away. However, they have been raising funds and they are looking to come back to the market. And Barron's ran an article on them last night, popped the stock overnight, and it has done really well for us. We took some profits on it for about 30% this morning. A stock that I just highlighted probably about an hour ago, Lazy Days Holdings, is a SPAC that came to the market about 2 years ago and was forgotten about. About an $80 million market cap company that focuses on RVs. And as I've stated in recent months, this market is extremely hot. I was on a road trip a couple weeks ago, and I mean, I can't even tell you how many RVs I saw on that 2-hour drive. I was just absolutely stunned. And I was holding off highlighting Lazy simply because I was somewhat bearish on the market, which explains why I've been somewhat quiet, less active in my intraday trading. I've kind of just been waiting for a market pullback to try to find opportunities at more compelling levels. Lazy, however, started to break out today to 52-week highs and is setting up for a break of all-time highs at the $10 area. And the RV trend will just continue, especially as COVID cases tick up again. It's become a new way of life for people. And I honestly think that with, you seeing the colleges that are shutting down, that are planning to have online classes, that just a couple of weeks ago were saying we expect to have students on campus. I think the same is going to be happening in a lot of school districts. And with parents continuing to work from home, you may just see some of them just take to the road. I mean, I think the RV industry is mainly a summer industry, but I think you will see people just rent RVs or buy RVs and just take the entire family on the road. So I think that may help drive demand into the fall. Here, I have a question here. Let me see what this is before I go to the next subject. Curious, let me read this out. Curious to know if there is any reason why we're seeing this now rather than standard IPO process, i.e., why haven't we seen this in the past? Was there some legal or regulatory change, or is it because of valuations, or is it just a fad? It's a good question. I mean, so some of these deals have been out here. Typically with a SPAC, you have 2 years to close a deal. So most of these SPACs have just been out here sitting around looking for something to buy. And valuations on everything were pretty expensive. So I think that's why you didn't see a lot of these deals come to market. IPO investors or IPO underwriters don't mind bringing a deal to market at a high valuation because they're just getting the underwriting fees. I mean, they don't care if, generally if the stock doesn't help, post-IPO investors make money. However, SPAC investors are in it for the long term. I mean, they're basically in it at the same price as the retail investor. So it's important to them to find value-driven deals. And so there are dozens of these things just sitting out there looking for something to buy. And you're only going to see more and more come to market just given the success that we've seen in some of these deals. I know I saw something that one of the big fund managers was planning to do like $1 billion SPAC pretty soon. So I think that might be the biggest SPAC ever raised. So there's a lot of money sitting out there ready to pounce, and with all these new retail investors demanding not RV plays, but electric vehicle plays and alt energy plays, and everything that kind of fits within their kind of lifestyle and their areas of interest. I think there's been a pivot from looking at energy and kind of more classic buyout types of names into some things that are a little bit more esoteric, but the valuations can get really high. I mean, so obviously you see Tesla is basically trading at a higher market cap than all vehicle makers combined. I think I saw that somewhere. So if they're $200+ billion market cap, I mean, you're seeing deals, people feel like, hey, if I can get something at $1 billion market cap that'll grow over time, maybe it'll be the next Tesla. I mean, and you're seeing that in stocks like NEO, which I don't necessarily consider. Well, I mean, I don't know. I have not been a huge fan of NEO in the past, but it doesn't matter. I mean, stocks is surging. So yeah, so SPACs are here to stay for the time being.
Yeah, Damon, I think it was Bill Ackman that filed for a $3 billion SPAC this week.
Wow, $3 billion. That's fair. I mean, typically, these deals have been, I'd say, $200 to $300 million. I mean, $3 billion, it would be by far the biggest deal ever done.
Pretty wild.
So, Damon, how do you know what is it based on some of the reputation of what they've done, similar to maybe like I don't know, private equity, like you mentioned? Do they have a reputation, and that's what you would get along with, or do you wait for them to find the investment idea and then go along with them?
Well, the interesting thing about SPACs, and kind of one of the reasons, actually the main reason I like them, is that to some degree you get a free look. So essentially the way most of them are structured is that they trade at around $10. Basically, they trade at the asset value, the value of the funds held in the bank, right? So the net asset value, and it just kind of sits there until they find a deal. And so once they find a deal, they basically give you, set up a shareholder meeting, and you get to decide if you like the deal or not. If you don't like the deal, then you basically get your $10 per share back. Now, if investors think, wow, this is a really attractive deal and it's underpriced, then they start to buy the stock. So maybe it's trading at 10, and we've seen things like SHLL, which Craig highlighted right after our last strategy meeting toward his acquisition. I think he highlighted that one around 15. It was trading around 10 or 11. They announced a deal with a kind of electric trucking company. Stock popped to 15. And as the news disseminated, this thing eventually went to 35. We have a swing trade on it in it right now. So as people find out about the deal and they start to look at the valuation, and they start to look at do relative value analysis by comparing this EV company that is being bought at a, say, $1 billion valuation, and it's growing at 300% per year. And then you have Tesla trading at a $200 billion valuation. People just start to pile in, and essentially what they're doing is getting in before the actual merger happens and converting their shares into the post-deal shares. Does that make sense?
Yes, it does. So, in this most recent case, SPAQ, you said that's the one that's been just kind of hanging around for a couple of years?
No, I just posted a swing long on the ticker Lazy.
Oh, that one. Okay.
Which is an RV play, and
right,
so
that's
that
right.
So but this is an example of what happens when most people don't know about SPACs, and they haven't. The negative thing about SPACs, and probably one of the reasons that a lot of companies don't do it, is doesn't really help Wall Street, right? And so one of the things that you get from IPO is analyst support. All of the underwriters roll out coverage about 30 days after the IPO or 20 days after the IPO, and they do the job of talking up the stock. With the SPAC, you don't really get that, So the company closes a deal and it just closes, and you kind of hope that retail investors like it, that maybe Barron's talks about it, and just kind of the word gets out. But there's really no way to advertise or to kind of get investors, especially institutional investors, behind these deals without the analyst community out there doing the touting.
Huh. It sounds a little bit like penny stocks on steroids.
Well, I mean, again, I consider it publicly traded private equity.
Uh-huh.
It's basically just like a private equity deal where private equity fund raises money and they're out looking for deals, right? And so, I like them because you basically, as an individual investor, get to participate in a private equity opportunity with no fees. I mean, you basically get your money back if you don't want to participate in the deal. And if it's a great deal, like if they end up buying something at a good price in a space that people like, you can make 3, 4, 5 times your money.
All right, very interesting. So what other areas are you looking for? I know we focused a lot about this one. You've got to be some other areas, because I thought it was important, something that you highlighted yesterday. You do think that there's potential for a pullback in this market, yet you're not looking to short.
Yeah, so, as I stated yesterday, I mean, obviously there's more money to be made on the long side than the short side, right? I mean, if you're shorting a stock, the most you can make is 100%, which is almost never going to happen. And so on the long side, wait on a pullback, especially in a volatile market like this that has a major overhang, such as COVID. You can see situations where a stock pulls back 30, 40%. And as you come out the other side of this thing, maybe it has potential of 100%, 200%, 400%, as we've seen on a number of occasions over the past several months. So I just feel that my time is better served researching compelling triple-digit opportunities rather than trying to jump out in front of every name that I think is overvalued and trying to clip it for a 10 or 20% pullback. And as you've seen, there's a lot of people out there trying to pick shorts, and they've gotten their heads handed to them. So I'm not really in the business of having my head handed to me. It's not a comfortable feeling.
Yes, we all know that feeling all too well.
Hey, Damon, can I jump in quick? I just want to ask a question. So with these SPAC companies, you said, they're great areas where you can, put a little money to work, and if you get lucky, it hits the right story, you do double, triple, quadruple your money in a very, very short time frame, especially as the market's been getting hold of them and doing, just ramping them up to new highs. Do you recommend selling it all out when you get such a windfall profit? Or are you gonna hang around for the long term,
Yeah, it really depends on the valuation, right? So as I noted yesterday when we bought the Fitzker play SPAQ, someone asked me like, what's my upside target? And I told them, if the company gets bought at $1 billion valuation, then I'm holding it long term, because a company like Fitzker, if you look at it as relative to NKLA or Tesla or some of these other names that are out there, if you're able to own this at $1 billion valuation, who says it can't go to 5 billion or 10 billion or 20 billion, right? So as long as I like to do relative value trades, and I like that as a relative value trade if it's bought at the right price. Now, if they buy it at a $5 billion market cap, that opportunity is less sexy, and I might actually just sell it on the news that the deal is official news that the deal is in the works. So it's really a matter of doing the analysis to see what the value of the enterprise is and the long-term opportunity.
That answer your question there, Blue Chip?
Yeah, of course.
All right. All right, fellas. So it seems like we've really covered a whole lot here today. Are there any issues that you guys wanted to bring up that we might not have touched on? Something that might be relevant as we head into the next month in earnings season?
No, not for me. I think I touched upon what I'd be looking at. Obviously, we'll have a lot of commentary going on as the earnings reports come out, and more interested in the price reaction because I think Craig did a good job at laying out expectations, which are for slightly better than expected results, as is per usual. But more interested to see if the stocks follow through. A perfect example would be Zoom, which in reaction to its earnings, which arguably was the best earnings report I've seen since I've been at Briefing, and that covers 20 years, about 80 earnings seasons, and it sold off in reaction. Now, granted, it recovered and eventually rallied higher, but really curious to see if there's follow-through on some of these software plays. And then on the flip side, if Wells Fargo would be a perfect example. If we see a clunker of a quarter, yet the stock hold up, does that maybe suggest time for sector rotation? So there's some of the early things I'll be looking at, but we'll be talking a lot about them throughout the course of earnings season.
All right, gentlemen. Well, I want to commend you all for a good conversation. I appreciate everyone spending some time and being able to get together and conversing over some of the key themes that we're going to be seeing over the next month or so. As always, we will have a copy on this probably this afternoon. So look forward to that. In case you missed it, you can get a recap. If you do have any questions, feel free to reach out to us. Use that Talk to Us button. If there's anything that we might not have covered or maybe a follow-up question, feel free to write in, and we will try to get that answered for you. As always, gentlemen, thank you so much for joining us, and we'll do this again next month.
All right, thanks, Jim. Everybody have a good one.
Thanks. Have a good one.
Thanks.